Hello, and welcome to the next session of Reflections on Investing by the Cornell Capital Group. And today we're going to continue on with our discussion of inflation because this is just such an important topic in today's economy and for today's investors. And the topic today is three flavors of inflation. And let me tell you what I mean by that. If we go to the iPad here are the three flavors. One is actual measured inflation. That's a historical measure. And I'll tell you a little bit more about that in a moment. The next flavor is expected inflation. And that's more of a forward-looking measure, though we can talk about what people expected in the past. But typically, when we say expected inflation, we mean what they expect in the future. And the final is unexpected inflation. Which is the difference between what investors originally expected and what actually occurred. Or actually, it's the other way around. It's the difference between what actually occurred and what they originally expected. So we need to think about all three of these if we're interested in how inflation is likely to affect interest rates and stock prices. So to make it a little more practical, let's go on down here, and I've produced a little schematic and talk for a minute about the first measure, which is measured inflation. How is inflation measured? Well, it's done so by the Bureau of Labor Statistics, which is a government agency tasked with measuring inflation. And the way it does so, it identifies a basket of goods and services. And then it asks, how much does it cost to purchase that basket? And it does this every month. So to be specific, right now, this consumer price index, which is what it costs to produce that, to purchase that basket of goods and services, is 266.83. In a minute, I'll make sense of that number for you. A year ago, it was at 256.19. So if we want to know what the inflation was over the last year, it's the percentage increase in this consumer price index. And if you compute that, it comes out to be 4.15%. It's high now because the last couple months have had sharp bursts of inflation. So how does the Bureau of Labor Statistics do this? Well, they start with sort of an average bundle in 1983, which is set to a CPI of 100. So you can see between 1983 and today, we've had significant inflation because we're now at 266.83. But you might say, wait a minute, how could they be purchasing the same bundle of goods and services? Back in 1983, we still had CRT televisions. Computers were a minor fraction of what they are today. And the infamous cell phone hadn't even been invented, yet alone the modern smartphones that dominate our lives today. So how could the Bureau of Labor Statistics be purchasing the same bundle of goods and services? Well, they aren't. So they have to make adjustments for how the bundle changes. And that's a very difficult thing. It can be somewhat controversial, but they have a lot of experts, economists, marketing people, and so forth, who spend a lot of time doing that. And they try to adjust the CPI so that it effectively is purchasing the same bundle, adjusted for quality and technical changes every month. So that's how we measure inflation, percentage changes in the CPI. There are other indexes too, but the CPI is the predominant one. Now, the next thing we talked about was expected inflation. Well, before we go there, you might remember from the last session of Reflections on Investing that we had annual rolling inflation, is what I called it. Now it should make sense to you what that is. What that is just every month I compute the percentage difference between the current CPI and the CPI a year ago, and I roll it forward. And that's what we're looking at when we look at annual rolling inflation. And you might remember the inflation was very high in World War II, very high in the late 70s and early 80s, and quite low recently, around 2% on average, though it's popped up a little bit above that. But how do we get to expected inflation? Well, there are two ways. One way is to look at the financial markets, and the other way is to take surveys. So let's talk about the financial markets first. Remember from the last session, I talked about treasury bonds and treasury tips. Regular treasury bonds pay interest in nominal dollars, it's called, no inflation adjustment. Tips pay in real dollars, that is, they're adjusted for inflation. And here I have the 5-year treasury and the 5-year tips yields. And the nominal bonds that aren't adjusted for inflation have to pay a higher interest rate. The red line is the real interest rate, what you earn taking account of the change in purchasing power. And you might notice here right now on a 5-year tips, the government is going to pay you minus about 1.75%. So in other words, if you invested in a 5-year tip, you would lose 1.75% of purchasing power each year. But this difference between the two, between the nominal yield and the real yield, is a measure of the expected inflation. That's for 5 years. You can do exactly the same thing with the 10-year treasury and the 10-year tips. So if I compute this difference, that's going to be a measure of expected inflation over the next 10 years. And the 5-year is going to be a measure of expected inflation over the next 5 years. Now, in addition to financial markets, you can just go out and ask people, what do you think the inflation is going to be next year? And the University of Michigan has a famous inflation survey that's been doing this for decades. So let's take a look at these measures of expected inflation. The red line is from the 5 years. This is the 5-year differential. The black line is the 10-year, and this is Michigan, which is 1 year. So you can see they all move together, but by no means perfectly. The two financial measures are very tightly related, but the survey less so. So when you hear people say expected inflation, the first thing you should ask them is, whose expectations? But the expected rate of inflation is particularly important because research by financial economists have shown it's the primary determination of interest rates. So if expected inflation goes up, people who are lending money are going to say, geez, I've got to get enough back to compensate me for what I expect to be the inflation. And the higher the expected inflation, the higher interest rates. That's why there's so much discussion right now at the Federal Reserve about inflationary expectations. Well, what influences expected inflation? Well, perhaps the most important thing is unexpected inflation. If you tell me that someone can run a mile in 4 minutes, and I expect that you're right, so I expect them to be running a mile in 4 minutes, and they go out and do it in 5 minutes. If you ask me, what do I expect now? I'm going to adjust my expectations up from 4 minutes to maybe around 5 minutes. So it's the same way with inflation. To the extent that you make errors, you're going to adjust expected inflation. So what the financial experts are concerned about now is that if we have unexpected inflation, that will lead to higher future expected inflation, and that will lead to higher interest rates. So we've covered a lot of ground today, I know, but with inflation being front and center, you want to be certain you understand the 3 flavors: actual measured inflation, expected inflation, and unexpected inflation. This has been Reflections on Investing by the Cornell Capital Group. Thanks.